An associate is where a parent company owns between 20 and 50% of an underlying entity. We call this an associate. And we call it an associate because with a 20 to 50% shareholding, the parent company can exert significant influence on this underlying company it has a stake in. So an associate is where a parent company owns 20 to 50%. They don't have effective control, they have significant influence, and we call it an associate. So when the stake is purchased by the parent company in the associate, it is reflected in its books at the transaction price. In subsequent years, it is equity accounted for. It is equity accounted for. Very fancy term, simple meaning. Let's do an example. Let's say we've got a parent company and it buys a 20% stake in an associate for $100 million. It needs to reflect the value of this associate in its own balance sheet at the transaction price of $100 million. So it will have an associate in its balance sheet, $100 million, that's how much it paid for it. At the end of the year, if the associate company makes a profit after tax of, let's say, $50 million and elects not to declare dividend, we have to equity account for it. What does that mean? 20% of the $50 million can be attributed to the parent company's stake in that particular entity. So accordingly, 20% of the income of the associate is belonging to the parent company, and it should equity account for this proportion of its income. Accordingly, in its income statement, the parent company would reflect equity accounted earnings from the associate of $10 million. At the same time, the value of the 20% stake in the associate would also be increased by $10 million to reflect earnings accrued on the investment which have not been distributed. So the balance sheet amount, the amount that the associate is carried at in the balance sheet, would have an additional $10 million added onto it. We call this process equity accounting, and we equity account where the parent company has got stakes in underlying companies of between 20 to 50% and exercises significant influence. That is what we call equity accounting.